Most traders lose money not because the market is hard, but because they don't have a plan. In today's video, I'm breaking down the 5 pillars every trading plan must have if you want consistency. If you're serious about improving, hit the subscribe button and let's get started. Hashtag the 5 pillars of a complete trading plan. Most traders blame their losses on the market. Bad timing, choppy conditions, unexpected news, the list goes on. But here's the uncomfortable truth. Most trading mistakes don't come from what the market does. They come from what you didn't prepare for. The difference between a trader who survives and one who doesn't isn't luck. It's structure. It's having a framework that keeps you grounded when emotions run high, when the market moves against you, and when every instinct tells you to abandon your plan. This isn't about complicated indicators or secret strategies. It's about building a trading plan that actually works when you need it most, under pressure, in real time, with real money on the line. A proper trading plan breaks down into 5 core components. Each one serves a specific purpose. Remove any single piece, and you create a weakness the market will eventually find and exploit. These aren't optional extras or nice-to-haves. They're the foundation of consistent decision-making. Let's break down each pillar and understand why it matters. Hashtag the first pillar, routine. Trading doesn't start when you click the buy button. It starts long before the market opens, in how you prepare your mind and your workspace for the day ahead. Think about professional athletes. They don't just show up to the game and wing it. They have warm-up routines, mental preparation rituals, physical exercises that get them into the right state before competition begins. Trading requires the same approach. Your routine is what happens before you ever place a trade. It's the systematic process you follow to get ready. This means reviewing charts, marking important price levels, checking economic calendars, reading market commentary, and getting a sense of what's happening in the broader context. But it goes deeper than just looking at charts. A good routine involves removing old ideas that no longer apply. Markets change. What was relevant yesterday might be useless today. Part of preparation is cleaning your mental slate, invalidating old scenarios, removing outdated levels, and updating your understanding based on new information. Why does this matter? Because without a consistent routine, you start every trading day from scratch. Your preparation becomes random. Sometimes you check the news, sometimes you don't. Sometimes you mark key levels, sometimes you skip it. This inconsistency bleeds into your trading decisions. When preparation is random, execution becomes impulsive. You haven't done the mental work to understand the context, so you react to price movement instead of responding with a plan. You see a big green candle and jump in without knowing where support and resistance are. You exit a winner too early because you didn't identify your target beforehand. A routine makes your trading repeatable. It creates a mental checklist that ensures nothing important gets missed. It puts you in the right headspace before you risk capital. And most importantly, it builds confidence. Not the false confidence that comes from a hot streak, but the earned confidence of knowing you've done your homework. Your routine doesn't need to be complicated. It just needs to be consistent. The same steps in the same order, every single day. Over time, this becomes automatic. Your brain starts to expect it, and that consistency translates into better decisions when the market opens. Hashtag the second pillar, bias. Here's where many traders get uncomfortable. They don't like the idea of having a bias. They think it means being stubborn or closed-minded. But that's a misunderstanding of what bias actually means in trading. In trading, bias is not belief. It's not about being bullish or bearish and sticking to that view no matter what happens. It's a conditional hypothesis, a directional framework that guides your attention and keeps you from chasing every move. Having a bias means you've looked at the market and formed a view about the most probable direction. Maybe you think prices are more likely to go higher based on the structure you're seeing. Maybe you think they're going to drop. The specific direction matters less than having a clear answer to this question. What is your current market view? But here's the critical part that most people miss. It's not enough to have a bias. You also need to know exactly where that bias is wrong. This is what separates a useful bias from a stubborn opinion. A good bias comes with a clear invalidation point. It says, I think the market is going higher, but if price breaks below this level, I'm wrong, and I need to reassess. That invalidation level is just as important as the bias itself. Maybe more so. Why is this necessary? Because without a clear directional framework, you end up flipping back and forth emotionally. The market makes a strong move up, and you go long. Then it reverses, and you panic and go short. Then it bounces, and you flip back to long. You're not trading, you're reacting to fear and greed in real time. Emotional direction changes kill accounts. They rack up losses through whipsaw trades and keep you constantly on the wrong side of the move. It's exhausting mentally and devastating financially. A bias gives you an anchor. It helps you filter noise. When you know your directional view and where it's invalidated, you can ignore moves that don't align with your framework. You're not tempted by every little bounce or dip because you've already decided what you're looking for. This doesn't mean you ignore evidence. It means you've set clear conditions under which you'll change your mind. The market breaks your invalidation level? Fine, the bias was wrong, reassess, and potentially flip. But until that happens, you have a framework that keeps you from trading both sides poorly. Some traders pride themselves on having no bias, on being neutral and ready to trade in any direction. That sounds good in theory. In practice, it usually means they have no plan at all. They're waiting for the market to tell them what to do, and by the time the message is clear, the move is already halfway done. Having a bias doesn't mean ignoring risk or forcing trades. It means you've done the work to form a view, you know where that view is wrong, and you're focused on executing within that framework. It's strategic positioning, not emotional attachment. Hashtag the third pillar, levels. You can have the best idea in the world about market direction. You can be right about the trend, the catalyst, the fundamentals, all of it. But if you don't know where to act, that idea is worthless. This is where levels come in. Levels define location. They answer the question, where exactly am I willing to engage with this market? Not every price is created equal. There are zones where buyers and sellers meet with real force, where emotions peak, where liquidity sits waiting. These are the places where asymmetry exists, where the risk-reward ratio tilts in your favor if you know what you're looking for. Think about session highs and lows. These aren't random numbers. They represent the extremes of recent price action, the boundaries that bulls and bears have been fighting over. When price returns to these levels, something happens. Either they hold and price bounces, or they break and price accelerates. Either way, there's a clear reaction you can use. Or consider liquidity zones, areas where there are clusters of stop losses, pending orders, or concentrated interest. These zones act like magnets. Price is drawn to them because that's where the market can find the volume needed to fill large orders. If you're not watching these areas, you're missing where the real action happens. Levels are not just lines on a chart. They're decision points. They tell you where you're willing to engage, and just as importantly, where you're not. They create structure in what otherwise looks like chaos. Here's the problem. Many traders have vague ideas about where they'll enter. They think somewhere around here looks good, or I'll wait for a pullback. That's not a level. That's hope disguised as planning. Without precise levels, you end up reacting instead of trading. The market drops, and you think maybe you should buy. It keeps dropping, and you're not sure if this is the spot or if you should wait. Finally, it bounces hard, and you chase it, buying near the top of the move out of fear of missing out. That's not strategy. That's emotional trading dressed up with charts. Clear levels solve this. They give you predefined locations where you're ready to act. You mark them before the trading day starts, as part of your routine. Then, when the market trades, you're not making decisions on the fly. You're executing a plan you made when you were calm and objective. This doesn't guarantee success. The market can blast through your level without looking back. But even in failure, you have clarity. You know where you were wrong. You can review the trade and understand what happened. That feedback loop is how you improve. Vague trading produces vague results. You can't learn from a trade if you don't know why you took it at that specific price. Levels create precision. They turn abstract ideas into concrete actions. And in the heat of the moment, when emotions are screaming at you to do something, that precision is what keeps you disciplined. Hashtag the fourth pillar, execution. Having a bias is good. Knowing your levels is great. But none of that matters if your execution is loose and intuitive. Execution is where most trading plans fall apart. The trader has done the analysis, marked the levels, formed a view, and then when price reaches the zone, they hesitate. Or they jump in early. Or they wait for confirmation that never quite looks right. The setup is there, but the trigger isn't clear, so they either miss the trade entirely or take it with doubt. This is the cost of vague execution rules. When you don't have a specific trigger that confirms the trade, you're left relying on gut feeling. And gut feeling, in the moment, is just another word for emotion. Your execution rules need to answer one simple question. What exactly confirms this trade? Maybe it's a specific volume pattern. Maybe it's delta shifting in your favor. Maybe it's a candle formation at your level. Maybe it's all three together. The point is, you need to define it ahead of time, as clearly as possible. The clearer your trigger, the less room emotions have to interfere. If your rule says I enter when price taps the level and the next candle closes above it with volume, then you wait for that. No guessing, no internal debate. The conditions either happen or they don't. This doesn't mean mechanical trading where you ignore context. It means you've thought through what needs to happen for you to have confidence in the setup. You've backtested it, or at least observed it enough to know it has validity. And when those conditions appear, you act. Quickly, without hesitation. The alternative is exhausting. You sit there watching price, trying to feel whether this is the moment. Every tick creates doubt. Is this the entry? Should I wait one more candle? What if I miss it? What if I enter too early? This internal chaos drains your mental energy and leads to poor decisions. Rule-based execution removes that chaos. It gives you a specific thing to watch for. When it happens, you go. When it doesn't, you don't. Simple. But here's what trips people up. They think that having rules means they'll never miss trades or take losses. That's not the promise. Rules can't guarantee profits. What they guarantee is consistency. They ensure that every trade is taken for the same reasons, following the same logic. And that consistency is what allows you to improve. When every trade is based on a clear trigger, you can review your results and see patterns. You can identify which triggers work better in which conditions. You can refine your rules over time based on real data, not just feelings. Vague execution produces vague results. You take 10 trades, some work, some don't, but you can't really explain why because each one was slightly different. You entered based on a feeling here, a pattern there, a hunch somewhere else. There's no thread connecting them. So when you review, there's nothing to learn. Clear execution creates a feedback loop. Every trade teaches you something, because every trade was taken for a documented reason. That's how experience turns into skill. Without it, you're just repeating the same mistakes with different price levels. Hashtag the fifth pillar, review. This is the pillar most traders skip. They finish the trading day, close their platform, and move on with their life. If they made money, they feel good. If they lost, they try to forget about it. Either way, there's no systematic process for understanding what happened. This is a massive missed opportunity. Review is where growth happens. It's where experience gets processed and turned into insight. Without it, you're condemned to repeat the same patterns, make the same mistakes, and hit the same mental roadblocks over and over. A proper review asks specific questions. What worked today? What didn't? Were your levels accurate? Did your bias hold up? Did you follow your execution rules, or did you deviate? If you deviated, why? What was the emotional state that drove it? And just as important, which opportunities did you miss? Not to beat yourself up, but to understand what kept you from seeing them or acting on them. Was it hesitation? Lack of preparation? Poor level identification? Each missed opportunity is information you can use. The goal of review is not to judge yourself. It's not about labeling trades as good or bad based on whether they made money. Sometimes a perfectly executed trade loses. Sometimes a terrible trade gets lucky and wins. Outcome isn't the same as quality. What you're reviewing is process. Did you follow your plan? Were your decisions based on your framework, or did emotion take over? Did you respect your invalidation points? Did you honor your levels? When you focus on process, you start to notice patterns. Maybe you consistently exit winners too early when the market gets volatile. Maybe you hold losers too long hoping they'll come back. Maybe you trade best in the morning but make impulsive decisions in the afternoon. These patterns are invisible without review. But once you see them, you can address them. Some traders keep a detailed journal. Others use spreadsheets to track every trade with notes. Some record their screen and watch it back later to see what they were thinking in the moment. The specific method doesn't matter. What matters is that you do it consistently and that you're honest with yourself. Honesty is the hard part. It's easy to justify a bad trade when you're reviewing alone. You can tell yourself you had a good reason for breaking your rules. You can rationalize the impulsive decision. But that's just ego protecting itself. Real improvement requires looking at your mistakes without the filter of self-deception. Here's something nobody likes to hear. Without review, your progress stalls. It doesn't matter how long you've been trading or how much screen time you have. If you're not processing your experience deliberately, you're not turning it into skill. You're just accumulating time. Experience without reflection is just repetition. You can trade for 5 years and still be making the same mistakes you made in month 1 if you never stop to analyze what you're doing. Meanwhile, someone who trades for 1 year but reviews every session will learn faster and improve more. Review also helps with emotional regulation. When you sit down after the market closes and walk through your trades calmly, you start to separate the emotional heat of the moment from the cold analysis afterward. You see that the decision that felt so urgent in real time wasn't actually justified by your plan. That gap between how it felt and what you should have done is where growth happens. Over time, this gap shrinks. The more you review, the more your in-the-moment decisions start to align with your plan. You begin to recognize the emotional patterns before they take over. You catch yourself starting to deviate and can course correct in real time. That's mastery, not perfection, but awareness and control. Hashtag why all 5 matter. These 5 pillars, routine, bias, levels, execution, and review, are not isolated pieces. They work together as a system. Each one supports the others. Remove any single component, and the entire structure becomes unstable. Without routine, you start every day unprepared, and your bias formation suffers. Without bias, your levels lack context. You don't know if you're looking for support or resistance. Without levels, your execution has no anchor. You're guessing at entries. Without execution rules, all your preparation is useless because you can't act decisively when the moment comes. And without review, none of it improves. You stay stuck in the same patterns indefinitely. A trading plan is often misunderstood. People think it's just about entries and exits. Where do I buy? Where do I sell? How much do I risk? Those are important, but they're only one part of the equation. A real trading plan is a system for controlling attention, risk, and behavior. It's a framework that keeps you grounded when the market is trying to pull you into emotional reactions. It's structure that allows you to make decisions quickly but not impulsively, to take risk but within boundaries, to learn from every trade whether it wins or loses. The market is designed to exploit weakness. It doesn't care about your intentions or your goals. It will find the gaps in your preparation, the holes in your logic, the moments where discipline slips. That's not personal. It's just how markets work. They're efficiency machines, and inefficiency gets punished. Your defense against this is structure, not rigid, inflexible rules that don't adapt, but a solid framework that gives you clarity under pressure. That's what these 5 pillars provide. When you have a routine, you show up prepared. When you have a bias, you have direction. When you have levels, you have location. When you have execution rules, you have decisiveness. When you have review, you have growth. Put them together, and you have a plan that works not just on winning days, but on losing days. Not just in calm markets, but in chaos. Not just when you feel confident, but when you're uncertain. That's the point, to create stability that outlasts your emotional swings. Most traders never build this. They focus on finding the perfect indicator, the best strategy, the secret edge. They jump from method to method, always looking for the thing that will finally make it all click. But the real edge isn't in the strategy. It's in the structure that allows you to execute any strategy consistently. You could have the best trade setup in the world, and if your execution is emotional, you'll mess it up. You could have incredible market timing, and if you don't review your results, you'll never understand why you succeeded. Every component matters. Building this kind of plan takes work. It requires sitting down and defining each element specifically. What exactly is your routine? Write it down. What are the conditions for your bias and where is it invalidated? Write it down. What levels matter and why? Write it down. What triggers your entries? Write it down. What does your review process look like? Write it down. This isn't exciting work. It doesn't feel like trading, but it's the work that determines whether you're still trading in a year, or if you've blown up and quit because you couldn't control your decisions under pressure. The market will eventually expose every weakness. If you're winging it, if you're relying on intuition, if you're skipping preparation or review, if you're unclear about your triggers or levels, eventually, the market will find that gap and exploit it. It's only a matter of time. The traders who survive aren't smarter or luckier. They're more structured. They've built systems that keep them making rational decisions when everything inside them is screaming to do something else. They've turned trading from an emotional roller coaster into a repeatable process. That's what these 5 pillars give you. Not certainty. Markets don't offer that. But clarity. And in trading, clarity under pressure is the closest thing to an edge that exists.